There's still much confusion for many regarding a mortgage principal reduction and why a lender would be so eager to consider such a thing. Unlike a loan modification where a homeowner basically begs a lender for mercy in hopes of getting a lower monthly payment, and in some rare cases a principal reduction. A principal reduction program, or PRP, on the other hand, is quite different in many ways. Incidentally, national statistics show that voluntary loan modifications from the bank are successful only 8 to 12% of the time, depending on what lender is granting the modification. This average is way below the federal government's HAMP projection. Short sale success is also hitting the skids, so a principal reduction seems to be the way to go these days, and for good reason. So let's briefly discuss what constitutes a principal mortgage reduction and what motivations a lender has in allowing that reduction. First of all, think of a federally backed principal reduction program to the recent Cash for Clunkers program, where you trade in your old beat-up mortgage for a new government-funded reduced mortgage. Who wouldn't want that? A PRP is a TARP/private sector investor cooperative designed to stimulate the economy and get money moving again. So here's some examples on how a principal reduction can benefit all the parties. First of all, when you're talking about the homeowner, number one, the existing mortgage is bought by a private investor, whether it's over-encumbered or not. Generally speaking, the property is over-encumbered for the private investor to make an offer. Secondly, the mortgage over-encumbrance is then reduced to the fair market value. The monthly payment almost always comes down because interest rates are about 6.5%, and that's based on a newer reduced loan amount. Not to mention the fact that the old loan on record is paid in full. On the records, it looks really good on a credit report. And finally, no qualifying. A homeowner just needs verified income to meet a 40% a debt to income ratio. Now, with the private investor, the one that's going to actually buy the note from the bank, this investor can get cash flowing investments at huge discounts. Another benefit is that this product is plentiful and easy to find. There are many properties that are over-encumbered throughout the country. Private investors will realize that there's no real estate headaches associated with their purchase. They're buying the note, but not the property. Investors can also buy in bulk with literally no competition. There are so many properties out there that they can make offers on. And they can select their own inventory without having to take junkers. They can pick and choose whatever properties they want to make offers on and buy the notes. Why would the banks do such a thing? Well, there's many benefits to the banks with the principal reduction program. First of all, these notes can easily and cheaply be unloaded as non-performing assets. Secondly, the Troubled Asset Relief Program endorses the banks in their efforts to get rid of these notes. This will free up money for the lenders to lend after they get rid of these non-performing assets. Here's the real biggie. 80% of their losses are actually covered by the Fed after the sale. So in essence, the banks lose nothing. And to top it off, their stocks will return in value. The principal reduction program really is a win-win-win for all parties. When the money is gone, the principal reduction program will probably end. But, once again, everybody benefits. To find out more about getting a mortgage reduction, go to www.tinyurl.com/ultimate mortgage relief.